Hello investors, welcome to Simpli Stocks. Q1 or the June quarter earnings season has started on a very positive note. At the macro level, yes, uncertainty is back again. But despite that, many businesses have delivered good results. So in every earnings season, our goal is to cover as many well-performing businesses as possible for our YouTube audience. So in that direction, today, in the first video of our Q1 FY27 results series, I will cover 4 large cap businesses across 3-4 different sectors that have reported pretty good results. Now, hearing large cap, please don't just close this video right here. Just give me 1 more minute, because it is not that large caps do not make money. For instance, the businesses we will study today, even though they are large in size, but they are still growing very fast. The potential in them is no less than any small cap company. And look at it this way as well, that in the end, you should care about the return profile of a business. If a large cap has potential, then why not explore it? In fact, the benefit of large caps is that often their valuation re-rating happens quickly, as so many market participants are tracking those businesses, right? So without any further delay, let's quickly get started. The first business on our list today that has posted a strong April to June quarter results is ICICI Prudential Asset Management Company. Now, in very simple and brief terms, ICICI Prudential AMC or ICICI AMC runs mutual funds. Apart from mutual funds, they also offer services like PMS, AIFs, SIFs, but their primary revenue driver is the mutual funds and ETFs. Now, what is special about ICICI AMC is that it is growing fast by taking market share away from UTI AMC and other competitors. As you can see in this screenshot, that mutual fund industry's quarterly average AUM grew by 15.4% compared to the last year. Equity schemes also registered a growth of 16%, and if we look at the closing AUM, it grew by 10.7%. But quarterly average AUM is a better metric to track. So despite so much volatility, the market has performed quite well, so that we can say people have generally continued with their SIPs. Now, there was a slight slowdown in April and May when several investors halted their SIPs, but from June onwards, the industry is back on track again. That is why if you look quarter on quarter, you will notice a slight difference in SIP flows. June saw slightly lower inflows compared to the March quarter, but that is back on track. Apart from that, unique investors, that number has gone up by 12% compared to last year, to reach 6.19 crore. And on a YOY basis, SIP flows also registered a solid growth of 16.5%. These numbers are a bit special because earlier what used to happen, that new investors usually came in only during the bull run. Now this trend is shifting slightly. Investor participation is visible right from the market bottom. Now coming directly to ICICI AMC's numbers. So here you can see that quarterly average AUM grew by 17.6% over the last year. And as I was just telling you, the sector itself saw a growth of 15.4%. So this means it has grown faster than the market. Equity schemes saw a growth of 19.5%. Debt mutual funds, yes, they remained flat for both industry and ICICI AMC. There is no momentum here, and this happens during uncertain times because debt funds are mostly preferred by corporates and medium-sized businesses. But due to the war and supply chain disruptions, companies are taking money out of debt mutual funds to build extra inventory. They are investing in working capital, so their businesses keep running smoothly. So that is entirely normal. Now, ICICI is India's second largest player in the asset management space after SBI. They hold a total market share of 13 to 14%. And because of this massive scale, they have mutual funds across every category. So this helps them significantly because no matter what requirement a customer comes with, they have all products available. Now, let us quickly look at their results. So here you can see that their operating revenue increased by 17.6% over last year. Other income also showed a strong growth of 23.1%. Operating revenue includes fee income that we pay for any mutual fund. Other income includes the investments which are owned by the AMC itself. So in the previous quarter, due to market volatility, there was a loss in other income. But as the market picked up, other income saw very good growth. Then now here moving down, you can see that operating profit grew by 20% compared to the last year. Now, last quarter, I had discussed some developments that were taking place within the company, such as ESOPs, and then they also acquired management of 5 funds from ICICI Venture Funds. So the fees associated with all of that, so those things have now normalized. Besides this, their yields or fee that they charge, that remained stable as well. So all in all, I'll say good set of numbers. Now, although macro level tensions have come up again, but hopefully as the market recovers from here, SIP inflows will rise further. On the top of that, AUM growth will add up a separate level of growth. So it is possible with all that in the near future, ICICI AMC might start delivering 25 to 30% plus growth. And that is the very speciality of wealth management companies, that they have classic annuity models. Annuity model, you can understand like this, that Indian markets have historically delivered 10 to 15% CAGR return on average anyway. And there add another 5 to 10% growth that comes from fresh SIP inflows. And this sector then can grow at a rate of 20-25% year after year. So that is the nature of such businesses. Additionally, for future growth, they recently launched an inbound fund in Gift City. Apart from this, they are launching life cycle funds, new contra funds, some ETFs, as well as real estate and other alternative investment funds. So these are small steps which will help to drive future growth. So these funds might not gather a big amount or big AUM right away. Like initially, the market response will be, let's say, a bit warm, not that good. But once a fund is launched, what happens is that its performance record that becomes public. Then after a 2-3 year good track record is built, it becomes easier for that AMC to market it by showing past performance of that scheme. So ICICI has advantage of scale because they have so many products across the categories. Also, whenever a bull run comes, now we don't know when will that be, but I believe that all AMC businesses will do well. So therefore, you can keep this business on your radar. Now, since we are talking about ICICI AMC, let us also look at Groww in the capital market segment. They have also posted pretty good numbers as well. Groww is listed by the name of Billion Brains Garage Ventures. And my interest in this stock has increased recently because it is a very technology-led and AI-focused stockbroker. Because of this, their margins should stay healthy. And we will get to see strong operating leverage playing out here. And there is not too much to explain about the business itself. So everyone already knows what a stockbroker does. So we will not go into that. Let us come straight to their Q1 results. So here in the June quarter, you will see that their total income jumped by a massive 63% to reach 1550 crore rupees approx. EBITDA also doubled, growing 101% year on year to 970 plus crore rupees. Similarly, net profit saw a solid 94% growth, or we can say it also nearly doubled to 735 crore rupees. So there was a strong margin expansion that we can clearly see. And as they are tech focused, and I have highlighted this a couple of times with the examples of Aurum and Cartrade, that once for a tech business platform is built, the cost to run it further does not increase significantly. So going forward, no matter how fast revenue or sales grow, costs won't grow at the same pace. So margins will expand and profit growth will be very, very strong. So that is there. And you will notice this in their financial metrics too, that operating leverage is clearly playing out. Despite such a strong revenue growth, both platform costs and marketing costs, so they have decreased as a percentage of revenue. Like tech costs reduced from 14.6% to 10.7%. That is why such strong EBITDA and net profit expansion came. Operating metrics have also remained very healthy. Transacting users grew by 24% year on year to reach 2.2 crore. Their active user base has now reached 1.7 crore. Customer assets also surged 38% to reach 3.6 lakh crore rupees. This is the money that customers have invested through Groww in stocks, mutual funds, etc. And then an additional 23,000 crore of investments came onto the platform in this single quarter itself. Furthermore, they have gained market share across all categories. So this is visible on my screen. I won't go into excessive detail, but you can pause for a minute here and check this slide. So here you will see in mutual funds, their market share stands at 14.1%. In the stock segment, it has increased from 11.8 to 15.1%. Similarly, in the equity derivatives, that is futures and options, their retail market share rose from 7.2 to 11%. And the MTS, or the margin trading facility book, you will see it is usually strong for bank-backed brokers because they offer lower interest costs. But even then, Grow's MTF book that has expanded quite well. Also, last year, after the restrictions that the market regulator SEBI put on retail investors for FNO trading, so we can see Grow's revenue is also changing. Sorry, the revenue mix is also changing, just like the rest of the industry. In Q1 last year, equity derivatives made up 56.4% of revenue. But now the contribution from new products is gradually increasing. Plus, they have rapidly gained market share in commodity derivatives, reaching a retail market share of 29% there. MTF and loans against shares and mutual funds have also grown. Here, the company provides loans to investors by keeping their holdings as collateral. So that segment has also done well. Besides this, they have launched their own funds, that is Groww AMC, and Groww AMC's AUM has also grown by nearly, I think, 140% over the last year, and now it is almost touching 5,500 CR. Now see, Angel One's results were also good. I'm not denying that. But if you measure, you will see better operating leverage that is playing out in Groww. This business gives you advantages or benefits of a platform business. Angel One is focusing more on growing its MTF loan book, whereas Groww has maintained a, let's say, product-led approach. Offer a good experience, market it well, market your products well, and also attract more customers. So that is where Groww is focusing. Of course, they are also growing their MTF business. Like, management was quite positive about it during the con call. They mentioned that adoption is still in its initial stage and there is significant scope for both growth from the existing customers, meaning higher ticket sizes, and also new customer acquisition. So growth scope is from both these areas. So they are also focusing on growing their MTF loan book. In addition, they are also leveraging AI effectively, ranging from customer support to SIP renewals and all that. This quarter, like, they launched AI-powered MF Prime, which helps users to manage their mutual fund portfolios. They have also built a dedicated wealth management platform for HNIs, so that is also performing quite well. Similarly, they are about to launch investment services for US stocks as well. So there are several such launches planned. So Groww is also a very solid business that you can keep an eye on, and I think it should also trend during the next bull run. So you are seeing, right, that even though Groww or ICICI AMC are fairly large in size, there are certain growth triggers that if they play out over the next, let us say, 2 to 3 years, so these businesses can create a lot of value. And that is why you have to drop that bias that only small cap or micro cap companies are good. At the same time, you should also understand that in sectors where these companies operate, like one is an AMC and the other one is a stockbroker, and just as I talk about Adani Ports a lot, so there are certain sectors where advantage comes eventually with the size itself. Like at a small level, you cannot do very much. But I will also say that you have to be very selective. Like, it should not be that just for the sake of buying large caps, you are filling your portfolio with HDFC or Reliance like that. But I will also say, for a normal retail investor, it is not possible to spend so much time in picking good businesses out of so many stocks and then studying them so deeply. That is why we have created a personal WhatsApp community for serious investors where we closely track more than 100 good businesses for you. This is across the whole market universe, from large, mid caps to small cap and even micro cap businesses. I discuss everything in detail, like their business model, valuation, risk factors, and how are their results. Everything is discussed in detail. Here, I also share my portfolio and I clear all your doubts on a one-to-one basis. But remember, this is a paid community and there are two plans in this. 6,000 rupees for 6 months and 10,000 rupees for a full year plan. In the 6-month plan, your monthly cost will average to just 1,000 rupees, and in the full year plan, your monthly cost will be just 850 rupees. So if you are interested, send a WhatsApp message on this number, or else you can contact us and join this community through also the link which I have provided in the description below. Coming back to our discussion, the third business on our list is Polycab India. I will not go into details of Polycab's business model because everyone already knows that they are in wires and cables. Yes, they also have FMEG and EPC divisions. Like in FMEG, they sell electrical items like lights, fans, switches, and also solar inverters. So that is doing quite well for them. As for the EPC segment, they execute various projects, like they are currently working on the BharatNet project. Now, if we see segment-wise, the company's main business is of definitely wires and cables, which brings about 85 to 90% of their sales. After that, FMEG holds about 9 to 10% share, and EPC segment contributes roughly 4 to 5%. Now, let us come straight to their results. So here, you will see that their sales grew by 39% compared to the last year. So these are good numbers. Then you will see that both EBITDA and net profit grew by 32 to 33%. But in this, a major portion of the sales growth which you are seeing is because of the raw materials like aluminium and copper. They went up. So that is why sales growth is so looking so well, because Polycab basically works on the cost plus model. So if the prices of copper and aluminium increase, those costs are passed on to the customer. So that is why sales are looking so high. Otherwise, if we look in terms of volume growth, so their volume growth is in the low to mid single digits, that is about 2 to 5%. But even then, I will say these are good numbers, because this growth has come on the top of very high base from last year. Like in Q1 last year, cable volume growth was around 25% and wire volume growth was about 20%. In this quarter, wire volumes were better than cable volumes. But yes, overall revenue growth came mainly due to rising commodity prices. Still, I will say these are pretty good numbers. Their previous quarter, as in Q4, was also good. So that is why you should not look at this on a quarterly basis, because industry sales volumes keep fluctuating. So you should rather keep a yearly or medium term outlook. Like for the full previous year, their volume growth was 18% in FY26. Also, wires and cables as a sector is also doing quite well right now. Like strong growth triggers are playing out across multiple sectors. Continuously, investments are increasing across all areas, from green energy to power transmission, railways, logistics, and also real estate. So because of this, the demand for wires and cables is also coming from everywhere. At the same time, new segments like EV charging, infrastructure, data centers and defense, so they are also creating fresh demand. So therefore, even though Polycab has rallied so much, I still feel this is one of the good businesses among large caps. Like for one, their growth guidance itself is to keep growing at 1.5 to 2 times the rate of the overall industry. And as for their profit margins, so those have also stayed strong. And as for the margins, they have several triggers also for future. So they will also keep margin high. For example, in this quarter, the share of wires was higher. But usually what happens is that cables make up a larger share and margins are better over there. Similarly, channel sales were higher than institutional sales, although that is a good thing. Channel sales mean sales which are coming through their own, not own, but let's say which are coming through their distributors. So margins are higher over there. In institutional sales, let us say a project is being executed somewhere. So they directly supply cables for that project in bulk. Hence, margins are lower. Apart from this, exports were affected due to the Middle East war. So the full benefit of operating leverage could not be realized. But as exports return to normal, so that will also drive margin expansion too, because profit margins are higher in exports. So when all these triggers play out together in the future, higher cable sales, better channel mix, and then exports along with operating leverage benefits, so their margins will remain strong going ahead as well. Yes, one thing is that in their results that might look unusually positive to you is that their working capital cycle, so that came down to just 15 days. So this is not a permanent improvement. Letter of credit was used to buy raw materials. So payable days have temporarily increased. In the coming quarters, the working capital cycle will return back to its normal range of 45 to 50 days. But yes, overall, Polycab's performance has been good, and you can study this business independently once. Now, let us move forward and quickly look at Eternal or Zomato for today's fourth and final business analysis. So we all know about Eternal's business. It is mainly into Zomato food delivery and the Blinkit quick commerce business. They have other businesses too, like Hyperpure and District. But right now, their contribution is not that large. And in fact, even food delivery is not the main growth driver for Eternal anymore. Growth has slowed down over there. That sector is maturing. The main investment thesis in Eternal is Blinkit right now, which is growing quite fast. Now, let us come straight to their results. So on a consolidated basis, here you will see that the total value of items customers ordered, or basically NOV, grew by 54% compared to the last year, and adjusted EBITDA grew by 223% to reach 555 crore rupees. So this is the main highlight of the results. We are seeing very good profit margin expansion, and I'll discuss this further. And looking at the segment-wise growth here, you will see that the food delivery business saw a 20% growth compared to the last year, and it will continue to grow in the 15 to 20% range going forward as well. Their district business, the going out segment, is still in its early stages. So investments are being made over there and money is being spent on growth and marketing. So it is still operating at a EBITDA loss level. As for the Hyperpure, which is their B2B restaurant supply business, there is decline in growth here due to the war. Restrictions were put on commercial gas. So that affected operations for many restaurants. But that is, I will say, a short-term issue, and that is as such not a major risk. Now, let us come to the most important segment, which is obviously Blinkit, and the main growth trigger also for Eternal. Now, here you will see that NOV at Blinkit, so that has grown by 86% over the last year. If you look at sales, there is 553% growth, but that looks so high because Blinkit has shifted to keeping its own or holding its own inventory. So NOV is a better metric for tracking actual growth for a few quarters till this new standard stabilizes. And we also saw a very good improvement in the profit margins. This is what makes their results quite interesting. So that here you will see that adjusted EBITDA margin has reached 0.6%, which was 0.3% in the previous quarter. So despite so much competition in the market, Blinkit has reached, we can say, break even or slight profitability at the EBITDA level. So Eternal basically does not has to run its quick commerce business at loss like Zepto or Swiggy. Then you will see here other metrics too, like monthly active customers increased by 17% compared to the previous quarter. The store count grew 58% over last year, and they now have more than 2,440 dark stores across the country. The market, I'll say, is maturing slowly. From here, Blinkit has a target to reach 3,000 stores by the end of this year. Now, let us also look at their cash balance, because in any loss-making company, or let us say in any expanding tech business, this is very important. Although you will see that here that compared to last year, cash balance has reduced, but on a quarter-on-quarter basis, there is an addition of 316 crore rupees. And here income from their treasury investments also contributed to this. But yes, overall, Eternal, we can say, has reached a position of minimal cash burn, or we can also say it has reached a position of stable cash burn. So firstly, growth is good over here. Margins are expanding. Plus, unlike other players in the market, they do not have to run their operations by burning massive amounts of cash at loss. Now, around late March, or I think I remember around early April, I had made a dedicated video on Eternal where I discussed this business in detail. Since then, both in terms of stock performance and also business performance, Eternal has done quite well. So I would suggest you go and watch that video, because if you are interested in this business, so you will get a very good understanding of Blinkit from that video. So I will put its link for you in the description below. It is a short video and you can go ahead and watch it. Now, personally, I feel that the quick commerce segment will definitely stay competitive, but every player might settle, let us say different players will settle into their own different segments. Like who knows, Big Basket or JioMart and DMart. So they will do well in scheduled slot delivery or 1 to 2 hour delivery times. Amazon and Flipkart's exact place is yet to be seen, but we will see, because they are in early stages. They are also burning a lot of money. As for Blinkit, they have captured the market of loyal, mature, and premium customers. So, and they will most likely they will continue to do so. So, in the short term, yes, competitive intensity may go up or down, but you have to see who has what kind of competitive moat and cash balance. You also have to see at what speed this cash is being spent. Like in Blinkit, this is a major plus point, whereas Swiggy or Zepto still have a significant cash burn. And as for Zepto, I see massive red flags, because when it comes to Zepto, their top line looks inflated because the ad revenue gets also added over there. In comparison, I find Swiggy or Eternal much more cleaner in reporting and all. So in the long term, I feel Eternal will definitely emerge as a stronger player. Quick commerce is a pure execution focused business. So slowly inefficient players like Zepto, let us say, I'm not saying anything, but let us say inefficient players, so they will get knocked out of the market. And you can keep an eye on Eternal. Valuation might be tricky for you, because competitive intensity may remain higher or lower over the next few quarters, but you have to track their store expansion rate, contribution, EBITDA margins, and also cash burn rate, because you need to understand the direction of the business over here. Because model wise, it is clear that Blinkit has a very differentiated and strong model compared to others. Other players are just running after discounts, throwing money, trying to attract customers, but they are not your loyal customers. The moment you stop discounting, heavy discounting, they will run away to other platforms. But I will say still Blinkit is much better much better compared to its competitors. Now, apart from all these things, they are also working on quick food delivery platform with Bistro, that is there, and also an AI powered customer support platform called Nugget or Nugget. But those are very small segments right now. One final highlight from their earning call was that earlier they had given an EBITDA guidance of 5 to 6% for Blinkit, but now they are expecting 6% margin. So, but also this is not any near-term guidance. But I also see that side by side they have also given a negative development. Although I would not call it purely negative, but it is not positive either. So that is the company has increased its capital expenditure guidance for each dark store. Earlier, they estimated an investment of 1 crore per store, but now they are focusing on automation and also opening larger format dark stores. So going forward, the investment per store can go up to 2.5 CR. But in every aspect, I'll say Blinkit is much ahead of its competitors. So this will help in future growth, like how they are expanding their product range, and they are also now stocking premium products. So similarly, they are also bringing smaller ticket size products because that supports margins. So all in all, Blinkit is doing all the right things when it comes to the sector. So this is a good business that you can look at. And now see, in the end, I will say the earnings season has just started and companies are releasing their results very fast. So if you are new to our channel, make sure to subscribe to Simpli Stocks. We will keep bringing many more business analysis like these to you. And if you enjoyed this video, please do like it. And if you support us with your likes, we will be able to bring much more videos for you like these on a regular basis. And if you have any doubts about these businesses, you can ask us in the comments. I'll see you in the next video. Happy investing.